I think it's necessary we look at the relationship between corporate earnings and stock price. In other words, how does corporate earnings influence stock prices? Corporate earnings and stock prices, share a closely intertwined relationship. As earnings are, a fundamental driver of a company's valuation. So here is how this relationship works. Number one is earning as evaluation basis. Earning as evaluation basis. So in this case, you have earning per shares. Earning per shares, investors often use earning per shares, calculated by dividing the net income of the company all over the total number of shares outstanding. It serves as a key metrics to assess profitability. So a higher earning per share generally leads to a higher stock price, and a declining earning per share generally will lead to a declining stock price. We equally consider price to earning ratio. The price to earning ratio, compares the company's stock price to its earning. That's the current stock price of the company divided by the earning per share. So a higher PE ratio indicates future growth expectation, while a low PE ratio could reflect on the valuation or poor growth prospects. And this comparison must be done, in the same sector. It should be a kind of apple to apple comparison. Number three is positive earnings. Positive earnings and stock price growth. Consider positive earnings and stock price growth. When companies report strong earnings, it signals profitability and financial health. And this will attract investors, and they will pile in, and then they will drive the stock price up because of the increased demand. Stock price movement is a function of demand and supply. When you have a higher demand, then the stock price will rise. So you equally have a positive earnings surprises, often leads to immediate stock increase. In a case where the earning is more than what market participants expected, they call it earning surprises. You discover that the stock price will climb tremendously. Number three is negative earnings and stock price declines. Negative earnings and stock price decline. You need to understand the fact that whenever there's a weak or declining earnings, it's an indication of reduced profitability, and this will lead to a lower investor confidence in the stock, and it would force investors to sell the stocks. And in the case where you have increased selling momentum or increased selling activities, it would force the stock price to plummet. It would cause the stock price to plummet. And so negative earnings surprises can trigger significant sell-off. In a condition where investors expected the company will make a profit, and all of a sudden, the company sustained, a loss, you discover that and the stock price will plummet, almost instantaneously. It happens to a particular stock I have in my portfolio. The stock is doing very well, actually, but all of a sudden, the third quarter result, the company recorded a loss in the third quarter result. The company stock, dropped to a certain level, although it is up again, because when you consider the overall result, the company is still doing well. But for the fact that there was a drop in the third quarter result, then there was this particular drop in stock price. Number 4 is earning guidance and market expectation. Market is driven by expectation, not just fundamentals, but an expectation that the fundamentals will improve in the future. So companies often provide earning guidance to indicate future performance. They are expected by law to provide kind of earning forecast or earning guidance. So if guidance exceeds market expectations, stock prices typically will rise. Then conversely, a lower than expected guidance can result in price decline. So if investors expect a better profit and there's a lower than expected profit, the stock price will do. That's why companies tend to provide, should I say, average or below average kind of expectation in their earning guidance. They will provide a lower figure than what should you know um, than a lower than what investors will expect, so as to be able to cushion the effect should in case there's a negative surprise in earnings. Number 5 is long-term versus short-term impacts. Long-term versus short-term impacts. Please don't forget to subscribe to this channel and like this video so that I will have the incentive and the motivation to continue posting videos of this nature that are designed to make you a professional investor. So, a long-term versus short-term impacts. So, in the case of short-term, stock prices can fluctuate significantly based on quarterly earnings, just like I earlier said. Even quarterly earning reports can force a stock price to react, reflecting immediate investor sentiments. Then for the long term, sustained earning growth, over time supports long term, stock appreciation, making earnings a core component of fundamental analysis. That's why if I want to invest in a company and I am like given a single factor I will base my investment decisions on, I will choose earning. Because essentially earning governs everything. Earning is a key factor that determines stock price. All other ones are maybe based on sentiment and what. When it comes to strong fundamental analysis, earning is the most important factor that is worth considering. An increase in earning will certainly bring about an increase in stock price over time, and a declining earning over time will surely lead to a declining stock price, all things being equal. Number 6 is market sentiments and external factors. Market sentiments and external factors. You see, we can't divorce sentiment from market performance. Sometimes, stock prices deviate from earnings due to market sentiments, economic conditions, or industry trends. Participants in the market are human beings, and you know how human being behaves. Most of the times, they are influenced by sentiments rather than reason or logic. For instance, speculative bubbles may inflate stock prices beyond their earning-driven value. Whenever there's that's bubble, investors tend to neglect earnings and then they keep on buying and forcing the stock price to go up unnecessarily. Number 7 is dividends and retained earnings. Dividend and retained earnings. So profitable companies may distribute earnings as dividends, attracting income-focused investors. When the company announces dividends, sometimes you tend to see investors piling in to partake in the dividend, share the dividend the companies would eventually share out, and then the share price will skyrocket, will climb. For instance, speculative, you discover that whenever there's that the return earning actually is not given out as it's not paid out as dividends, then it will affect the stock price, in a certain manner. If it is reinvested into growth, when the company grows, well, it will affect the stock price. If it doesn't grow, despite the fact that there's there's a positive earnings, the company share price may not rise as expected. So in conclusion, corporate earnings are a critical factors, that uh, influences stock prices. While other factors like market sentiments and macroeconomic conditions also play a role, sustained earning growth is essential for long-term stock appreciation. Therefore, investors, you know, uh, should closely monitor earnings and forecast, as well as earning forecast to uh, be able to make informed investment decisions.